Section 2:1-2.3 Hedge Fund Investment Strategies, Hedge Funds, Strategies and Techniques for Advanced Investing, 2.1 Long/Short Equity, Fundamental Analysis and Stock Selection in Long/Short Equity Strategies. Fundamental analysis and stock selection play a crucial role in long/short equity strategies employed by hedge funds. Here's an overview of how these elements are typically approached. Fundamental analysis, objective. Fundamental analysis involves assessing the intrinsic value of a company by evaluating its financial statements, industry position, competitive advantages, management quality, growth prospects, and other relevant factors. Approach. Fund managers perform in-depth research and analysis to understand the key drivers and risks associated with individual companies. They examine financial metrics such as revenue, earnings, cash flow, and balance sheet strength. Additionally, they evaluate qualitative factors like market trends, competitive landscape, regulatory environment, and management's track record. Tools and techniques. Fundamental analysis may involve ratio analysis, discounted cash flow, DCF, modeling, valuation multiples, earnings forecasts, industry comparisons, and scenario analysis. Research may also include meeting with company management, industry experts, and conducting on-the-ground investigations. Information sources. Fund managers rely on various sources of information, including company filings, financial reports, industry reports, news articles, expert opinions, and proprietary research. Stock selection, objective. Stock selection involves identifying individual securities, both long and short, that are expected to outperform or underperform their peers and the broader market. Approach. Based on the results of fundamental analysis, fund managers make decisions on which stocks to include in their portfolio. Long positions are taken in stocks believed to have strong growth prospects, attractive valuation, favorable industry dynamics, or other positive catalysts. Short positions are established in stocks expected to face challenges, exhibit overvaluation, or have negative catalysts. Risk management. Stock selection is guided by risk management considerations, including diversification, position sizing, and monitoring of portfolio exposures. Fund managers assess the potential risks and rewards associated with each investment and adjust portfolio positions accordingly. Portfolio construction. Long/short equity strategies typically aim to build a balanced portfolio with a combination of long and short positions. The goal is to create a portfolio that has a net exposure to the market, beta, close to zero, reducing exposure to overall market movements while capturing relative performance opportunities. Successful stock selection in long/short equity strategies relies on the fund manager's ability to identify undervalued or overvalued stocks and accurately assess their future performance potential. Additionally, ongoing monitoring and adjustment of portfolio positions based on changing market conditions and new information are essential for managing risks and capturing opportunities. Understanding market neutrality and factor exposure. Market neutrality and factor exposure are important concepts in investment strategies, including long/short equity strategies. Here's an explanation of each. Market neutrality. Definition. Market neutrality refers to an investment strategy's aim to eliminate or minimize its exposure to broad market movements or systematic risk factors. Objective. By achieving market neutrality, the strategy seeks to isolate the skill or stock-picking ability of the fund manager from general market trends. The focus is on generating returns from the specific securities or factors the fund manager believes will outperform or underperform, rather than relying on overall market direction. Approach. To achieve market neutrality, a long/short equity strategy typically balances the exposure to long positions, betting on securities expected to rise in value, with short positions, betting against securities expected to decline. By having roughly equal dollar amounts invested in both long and short positions, the strategy aims to minimize the impact of overall market movements on the portfolio's returns. Factor exposure. Definition. Factor exposure refers to the sensitivity or exposure of an investment strategy or portfolio to specific systematic risk factors that drive returns in the market. Objective. Understanding and managing factor exposure allows fund managers to target specific risk premia or investment factors they believe will contribute to the portfolio's performance. Approach. Factors can include common risk factors like market risk, beta, size, value, momentum, quality, and others. Fund managers may deliberately overweight or underweight certain factors based on their investment thesis or market outlook. They assess the factor exposures in their portfolio through quantitative models or risk analysis tools. Risk management. Managing factor exposure involves monitoring the portfolio's sensitivity to different factors, maintaining a desired factor balance, and avoiding excessive concentration in a single factor. It helps ensure that the portfolio's performance is driven by the intended factors and reduces unintended exposures that can lead to unexpected outcomes. Market neutrality and factor exposure are closely related concepts. Achieving market neutrality allows a fund manager to focus on capturing specific factor-based returns or idiosyncratic opportunities while minimizing exposure to overall market movements. By managing factor exposure, fund managers can target and control the risk and return characteristics of their portfolios, aligning them with their investment objectives and strategies. Managing portfolio risk and position sizing. Managing portfolio risk and position sizing are critical aspects of investment management. Here's an overview of how these elements are typically approached. Portfolio risk management. Risk assessment. Fund managers assess various types of risk, including market risk, sector risk, concentration risk, credit risk, liquidity risk, and operational risk. They analyze the potential impact of these risks on the portfolio's performance and stability. Diversification. Diversification is a risk management technique that involves spreading investments across different asset classes, sectors, geographies, and securities. It helps reduce the impact of individual security or sector-specific events on the overall portfolio. Risk monitoring. Ongoing monitoring of portfolio risk is essential. Fund managers use risk management tools and techniques to track portfolio exposures, measure risk metrics, such as volatility, beta, or value at risk, and identify any deviations from the desired risk profile. Regular risk analysis helps inform portfolio adjustments and risk mitigation strategies. Position sizing. Risk-reward assessment. Fund managers assess the risk-reward characteristics of each investment opportunity. They consider factors such as the expected return, volatility, liquidity, and correlation with existing portfolio holdings. Position limits. Fund managers set position limits to ensure that no single investment or sector dominates the portfolio. Position limits are determined based on risk tolerance, investment strategy, and regulatory requirements. Portfolio optimization. Optimization techniques may be employed to determine the optimal allocation of capital across different investments. These techniques aim to maximize risk-adjusted returns and consider diversification benefits. Risk-adjusted position sizing. Fund managers may adjust position sizes based on the riskiness of each investment. Higher-risk investments may have smaller position sizes to limit their impact on the portfolio's overall risk. Liquidity considerations. Position sizing also takes into account the liquidity of investments. Illiquid securities may warrant smaller position sizes to avoid difficulties in executing trades or exiting positions when needed. Effective risk management and position sizing require a balance between risk control and potential returns. Fund managers continuously assess and adjust their portfolio positions based on changing market conditions, risk factors, and investment opportunities. They aim to optimize the risk-reward trade-off while adhering to their investment mandate and risk tolerance levels. 2.2 Global macro. Analyzing macroeconomic trends and geopolitical factors is crucial for understanding the broader economic environment and its potential impact on investment opportunities. Here's an overview of how these factors are typically analyzed. Macroeconomic analysis. Economic indicators. Fund managers track key economic indicators such as GDP growth rates, inflation, interest rates, employment data, consumer spending, industrial production, and trade figures. These indicators provide insights into the overall health and direction of the economy. Economic research. Fund managers rely on economic research from various sources, including government reports, central bank statements, research institutions, and independent economists. They assess economic forecasts, outlooks, and trends to gauge the potential implications for different sectors, asset classes, and investment opportunities. Sector and industry analysis. Fund managers analyze the performance and prospects of specific sectors and industries within the economy. They consider factors such as supply and demand dynamics, regulatory changes, technological advancements, and competitive forces to identify investment opportunities and risks. Geopolitical analysis, political and policy analysis. Fund managers monitor political developments, policy decisions, and government actions that can influence the economic landscape. They assess the potential impact of policy changes on various sectors, industries, and investment themes. Geopolitical risks, such as trade disputes, conflicts, sanctions, political instability, and regulatory changes, can significantly impact global markets. Fund managers evaluate geopolitical events and assess their potential implications for specific regions. Industries, or companies, country and regional analysis. Geopolitical factors vary across countries and regions. Fund managers analyze the geopolitical landscape of different countries, including geopolitical alliances, economic integration, diplomatic relationships, and geopolitical tensions. They consider these factors when assessing investment opportunities in specific markets. Risk assessment and scenario analysis. Risk identification. Fund managers identify and evaluate the potential risks arising from macroeconomic and geopolitical factors. They assess the probability and potential impact of various scenarios, such as economic downturns, policy changes, currency fluctuations. Geopolitical conflicts or regulatory shifts. Scenario analysis. Fund managers conduct scenario analysis to understand the potential effects of different macroeconomic and geopolitical events on investment portfolios. This involves modeling and simulating different scenarios to assess portfolio performance under varying conditions. Fund managers use a combination of qualitative and quantitative techniques to analyze macroeconomic trends and geopolitical factors. They integrate this analysis with their investment strategies, asset allocation decisions, and risk management practices. By staying informed and assessing the potential impact of macroeconomic and geopolitical factors, fund managers aim to identify investment opportunities and mitigate risks in their portfolios. A top-down approach is commonly used in global macro investing, where fund managers analyze macroeconomic factors and trends to make investment decisions. Here's an overview of how the top-down approach is applied in global macro investing. Macro analysis, macroeconomic indicators. Fund managers analyze key macroeconomic indicators such as GDP growth, inflation, interest rates, exchange rates, employment data, and fiscal policies across different countries or regions. Global economic trends. They identify and monitor global economic trends, such as shifts in global growth dynamics, economic cycles, and structural changes. This includes assessing the relative strength of major economies and regions. Geopolitical analysis. Fund managers consider geopolitical factors such as political stability, trade policies, regulatory changes, and geopolitical risks. They evaluate how these factors may impact global economies and markets. Asset allocation, country selection. Based on macroeconomic analysis, fund managers identify countries or regions that offer attractive investment opportunities. They assess factors like growth prospects, interest rate differentials, currency dynamics, and political stability to determine favorable investment destinations. Sector allocation. Fund managers also consider sectoral trends within economies and allocate investments to sectors they believe will outperform or underperform based on the macroeconomic environment. Risk management, portfolio diversification. Fund managers utilize diversification across asset classes, countries, and sectors to manage risk. They aim to spread investments across different markets and regions to reduce the impact of specific country or sector risks. Hedging strategies. Global macro investors may employ hedging strategies using derivatives or other instruments to mitigate risks associated with currency fluctuations, interest rate changes, or other macroeconomic factors. Risk monitoring. Ongoing monitoring of macroeconomic factors, geopolitical developments, and portfolio performance is essential. Fund managers adjust their positions based on changing economic conditions and risk assessment. Execution, investment instruments. Fund managers utilize various investment instruments to implement their views, including equities, bonds, currencies, commodities, derivatives, and exchange-traded funds, ETFs. They may take long or short positions based on their macroeconomic analysis. Tactical adjustments. global macro investors may make tactical adjustments to their portfolios based on short-term market opportunities or changing macroeconomic conditions. This includes adjusting the asset allocation, sector exposure, or currency positions. The top-down approach in global macro investing allows fund managers to take a broad view of the global economic landscape and make investment decisions based on macroeconomic factors and trends. By analyzing macroeconomic indicators, geopolitical factors, and global trends, fund managers seek to identify investment opportunities and manage risks in their portfolios. Trading currencies, commodities, and interest rate products are common strategies employed by investors and traders. Here's an overview of these markets and the strategies used. Currency trading, Forex, Forex market. The Forex market involves trading one currency for another. It is the largest and most liquid financial market globally. Spot trading. Traders engage in spot trading, where currencies are bought and sold for immediate delivery. They aim to profit from fluctuations in exchange rates. Carry trade, in a carry trade strategy. Traders borrow in currencies with low interest rates and invest in currencies with higher interest rates to capture the interest rate differential. Currency futures and options. Traders can also use currency futures and options to speculate on currency movements or hedge their currency exposures. Commodity trading, commodity markets. Commodity trading involves buying or selling physical commodities such as crude oil, gold, silver, natural gas, agricultural products, and more. Spot and futures trading. Traders can participate in spot markets, where physical commodities are bought and sold for immediate delivery. They can also trade commodity futures contracts, which allow them to speculate on future commodity prices or hedge their positions. Fundamental analysis. Commodity traders analyze factors such as supply and demand dynamics, geopolitical events, weather conditions, and government policies that impact commodity prices. Technical analysis. Traders may also use technical analysis techniques to identify price patterns, trends, and support/resistance levels in commodity markets. Interest rate products. Interest rate markets. Interest rate products include bonds, interest rate futures, and options. They allow traders to speculate on or manage interest rate movements and associated risks. Bond trading. Traders can buy and sell bonds to capitalize on changes in interest rates. Rising interest rates generally lead to bond price declines and vice versa. Interest rate futures. Traders can use interest rate futures contracts to speculate on or hedge against changes in short-term or long-term interest rates. Yield curve trading. Traders analyze the yield curve, which represents the relationship between interest rates and bond maturities, to identify trading opportunities. They may execute strategies such as curve steepening or flattening based on their expectations of interest rate movements. It's important to note that trading in currency, commodity, and interest rate markets carries risks, including market volatility, liquidity risks, geopolitical events, and economic factors that can impact prices. Traders employ various strategies, including technical analysis, fundamental analysis, and derivatives trading, to identify opportunities and manage risks in these markets. 2.3 Event-driven, merger arbitrage and special situations investing are strategies employed by investors to take advantage of specific events or corporate actions. Here's an overview of each strategy. Merger arbitrage. Definition. Merger arbitrage, also known as risk arbitrage, involves taking positions in companies involved in merger and acquisition (M&A) transactions to profit from price discrepancies between the current stock price and the expected deal price. Approach. In merger arbitrage, investors analyze the terms and conditions of the proposed merger, including the offer price, payment method, cash or stock, regulatory approvals, and the expected timeline. They assess the likelihood of the merger being completed and the potential spread between the current stock price and the deal price. Risk considerations. Investors consider various risks, such as regulatory or antitrust hurdles, shareholder approvals, financing risks, and the potential for the deal to fall through. They manage their positions and adjust their holdings as the deal progresses, aiming to capture the price differential while mitigating the risks involved. Holding period. Merger arbitrage positions are typically held until the completion of the merger or until the spread between the stock price and the deal price narrows to an unattractive level. Special situations investing. Definition. Special situations investing involves taking positions in securities of companies undergoing specific corporate events or situations that can create value or generate attractive risk-reward opportunities. Scope of opportunities. Special situations can include events such as spin-offs, bankruptcies, restructurings, distressed debt, rights offerings, share buybacks, tender offers, or changes in corporate governance. Analysis and catalysts. Investors analyze the specific event or situation, assess the potential impact on the company's financials and valuation, and evaluate the catalysts that may drive a change in the security's price. Risk assessment. Special situations investing carries inherent risks associated with the specific event or situation. Investors evaluate the risks involved, such as legal or regulatory uncertainties, execution risks, or the potential for adverse outcomes. Time horizon. The time horizon for special situations investing can vary widely, depending on the specific event or situation. Investors may take a short-term position to capture the price impact of a specific event or maintain a longer-term position if they believe there is ongoing value creation potential. Both merger arbitrage and special situations investing require in-depth analysis, understanding of corporate actions, and the ability to assess risks and potential rewards. These strategies are often employed by hedge funds and specialized investment firms that focus on event-driven or special situation strategies. Analyzing corporate events and their impact on securities involves evaluating how specific events or actions undertaken by a company can affect its financial performance, valuation, and ultimately, the price of its securities. Here's an overview of the process. Identifying corporate events. Common corporate events include earnings announcements, mergers and acquisitions, M&A, spin-offs, divestitures, stock splits, share buybacks, debt issuances, management changes, regulatory approvals, and legal settlements, among others. Stay updated on company news, SEC filings, press releases, and industry publications to identify relevant corporate events. Fundamental analysis. Financial statements. Analyze the company's financial statements, including income statements, balance sheets, and cash flow statements, to assess its financial health, profitability, debt levels, and liquidity. Valuation metrics. Apply various valuation metrics, such as price-to-earnings, P/E ratio, price-to-sales, P/S ratio, or discounted cash flow, DCF, analysis, to evaluate the company's intrinsic value. Industry and competitive analysis. Understand the industry dynamics, competitive landscape, market trends, and the company's position within its sector. Evaluate the company's competitive advantages, market share, and growth prospects. Event-specific analysis. Impact assessment. Determine how the specific corporate event is likely to impact the company's financials, operations, strategy, and overall business outlook. Quantitative factors. Quantify the financial impact of the event, such as revenue growth potential, cost savings, changes in capital structure, or potential dilution from stock issuances. Qualitative factors. Consider qualitative factors, such as the company's strategic rationale behind the event, market sentiment, regulatory environment, and potential risks or uncertainties associated with the event, market reaction and investor sentiment. Market expectations. Assess market expectations and consensus estimates for the event to gauge how the market is pricing in the potential impact. Investor sentiment. Analyze investor sentiment and market reaction through stock price movements, trading volumes, options activity, and analyst reports. Deviation from expectations. Compare the actual outcome of the event with market expectations to determine whether the event had a positive, negative, or neutral impact on the securities. Risk assessment. Identify risks. Evaluate the risks associated with the event, such as regulatory hurdles, integration challenges in M&A, legal or compliance risks, or adverse market reactions. Mitigation strategies. Determine risk mitigation strategies, such as hedging or adjusting portfolio positions, to manage potential downside risks. Continuous monitoring and updating of analysis are crucial as new information emerges and the event unfolds. Investors should adapt their analysis and adjust their positions based on changing circumstances and the evolving impact of the corporate event. It's important to note that analyzing corporate events requires a combination of fundamental analysis, industry knowledge, financial modeling, and an understanding of market dynamics. It is recommended to conduct thorough research, consult reputable sources, and consider professional advice before making investment decisions based on corporate events. Risk arbitrage, also known as merger arbitrage or event-driven arbitrage, is an investment strategy that seeks to profit from price discrepancies between a target company's stock price and the expected deal price in a merger or acquisition (M&A) transaction. Here's an overview of risk arbitrage strategy. Identifying deals. Investors identify M&A deals that are pending or have been announced. They analyze the terms and conditions of the deal, including the offer price, payment method, regulatory approvals, and expected timeline. Calculating spread. The spread refers to the difference between the current market price of the target company's stock and the expected deal price. Investors aim to capture this spread by taking long positions in the target company's stock while shorting the acquiring company's stock, or by buying the target company's stock and hedging the risk using derivatives. Risk assessment. Risk arbitrageurs assess the likelihood of the deal being completed and the potential risks that could cause the deal to fail, such as regulatory hurdles, financing issues, or shareholder opposition. They manage their positions and adjust their holdings as the deal progresses to minimize risks. Returns and risks. Returns. The potential profit in risk arbitrage comes from the narrowing of the spread as the deal progresses and approaches completion. If the deal is completed successfully, investors earn the difference between the deal price and the stock price at which they entered the position. Risks. Risk arbitrage carries inherent risks, including deal failure, regulatory or antitrust issues, financing problems, unexpected changes in deal terms, or delays in the completion of the transaction. These risks can result in losses or a narrower spread than anticipated. Distressed securities. Distressed securities investing involves investing in the debt or equity of financially troubled companies, often in bankruptcy or undergoing significant financial distress. Here's an overview of distressed securities investing strategy. Identifying distressed companies. Investors identify companies facing financial distress, typically through bankruptcy filings, deteriorating financials, or other indicators of distress. Assessing recovery potential. Investors analyze the company's financial situation, including its debt structure, asset valuation, and potential for turnaround or restructuring. They assess the likelihood of the company's recovery and the potential value of its securities. Investment decision. Investors may purchase distressed debt at a discount to face value, seeking to profit from potential debt restructuring or recovery in bankruptcy proceedings. They may also invest in the equity of distressed companies, expecting a potential turnaround and increase in stock value. Active involvement. Distressed securities investors may actively engage with the company's management, creditors, or other stakeholders to influence the restructuring process and protect their interests. Returns and risks. Returns. Distressed securities investors aim to profit from the potential appreciation of the securities as the distressed company recovers or restructures. They can earn returns through debt restructuring, asset sales, or an improvement in the company's financial performance. Risks. Distressed securities investing involves substantial risks, including the possibility of the company's failure to recover, dilution of equity value, changes in bankruptcy laws, or other unforeseen events that can negatively impact the investment. Activist investing. Activist investing involves acquiring a significant stake in a company and using that position to influence or bring about changes in the company's management, governance, strategy, or capital structure. Here's an overview of activist investing strategy. Stake acquisition. Activist investors acquire a substantial ownership stake in a company, typically through the purchase of common shares or through derivative instruments. Engaging with management. Activist investors engage with the company's management, board of directors, and other stakeholders to advocate for changes they believe will enhance shareholder value. This may include proposing strategic initiatives, urging corporate governance improvements, advocating for a change in management, or pushing for a sale or merger of the company. Public pressure. Activist investors may use public campaigns, shareholder proposals, or proxy fights to gain support from other shareholders and put pressure on the company to implement desired changes. Returns and risks. Returns. Activist investors seek to unlock shareholder value by influencing positive changes in the company's operations, governance, or strategic direction. They may profit from an increase in the company's stock price or through other means, such as dividends, share buybacks, or asset sales. Risks. Activist investing carries risks, including the possibility of failure to effect desired changes, opposition from company management or other shareholders, reputational risks, or regulatory constraints. The investment may also require a substantial commitment of time and resources. It's important to note that risk arbitrage, distressed securities investing, and activist investing require specialized knowledge, analysis, and often a long-term perspective. These strategies can involve higher levels of risk and complexity compared to traditional investment approaches. Investors considering these strategies should conduct thorough research, understand the associated risks, and consider consulting with professionals experienced in these areas.